Every government tells you that central banks exist to serve the public interest, to stabilize currencies, manage inflation, and prevent financial panics. They're presented as neutral technocratic institutions staffed by experts who make decisions based on economic science and the welfare of society. But if you trace central banking back to its origins, you discover something far darker and more cynical. Central banks weren't created to serve the public. They were created to serve governments desperate for war funding and private bankers hungry for guaranteed profits. They emerged from backroom deals between monarchs who needed money to wage wars and financiers who saw opportunity in crisis. And the pattern established 3 centuries ago that central banks exist primarily to enable government spending and enrich financial elites has never fundamentally changed. Understanding the dark origins of central banking means recognizing that these institutions, despite their modern veneer of public service and technical expertise, were born from and continue to serve the interests of power and wealth. The mechanisms have grown more sophisticated, the language more complex, and the justifications more elaborate. But the fundamental purpose remains unchanged. Concentrate monetary power in institutions that can create money from nothing, lend it to governments at interest, and ensure that the public ultimately pays the cost. The story begins in 1694, not with enlightened economic policy or public-spirited innovation, but with desperation and opportunism. England was at war with France, locked in a conflict that would later be called the 9 Years' War, part of the endless struggle between European powers for dominance. King William III needed money, enormous amounts of it, to pay soldiers, buy weapons, equip fleets, and sustain military operations across multiple fronts. But the royal treasury was empty. Previous English monarchs had borrowed and defaulted so many times that their credit was worthless. Private lenders were reluctant to loan to a crown that might simply refuse repayment or worse, confiscate the lender's property in addition to not repaying the debt. This wasn't paranoid fantasy. It had happened before and would happen again. Lending to monarchs was extraordinarily risky, and interest rates reflected that risk, when loans could be obtained at all. Into this crisis stepped a group of London merchants and financiers led by William Paterson, a Scottish entrepreneur who'd previously attempted to establish a colonial trading company in Panama, a venture that would later fail catastrophically. Paterson proposed a deal that would solve the king's immediate problem while creating a permanent revenue stream for investors. A syndicate of wealthy individuals would raise £1.2 million, an astronomical sum representing perhaps 5% of England's entire annual economic output, and lend it to the government. In exchange, the subscribers would receive a royal charter incorporating them as the governor and company of the Bank of England. This new institution would have exclusive rights to issue banknotes, essentially creating a private money supply, and would receive guaranteed interest payments of 8% annually, funded by taxes on alcohol and shipping. The beauty of the scheme, from the banker's perspective, was that the loan would never be repaid. It would become perpetual debt, with the government paying interest forever, secured by the taxing power of the state. The subscription was successful beyond expectations. Wealthy merchants, landowners, and even foreign investors purchased shares in the new Bank of England, recognizing an opportunity for virtually guaranteed returns backed by government taxation. Within 12 days, the full £1.2 million was pledged. The bank received its charter on July 27, 1694, and began operations immediately. But the bank didn't just function as a passive lender holding government debt. Through its charter, it received the right to issue banknotes, paper currency that represented claims on the gold and silver supposedly held in the bank's vaults. This was the critical innovation, the mechanism that would transform banking forever. The bank could issue notes totaling far more than the actual precious metal it held because not everyone would demand redemption simultaneously. As long as confidence held, as long as people believed the bank's notes were as good as gold, those notes would circulate as money, expanding the money supply far beyond the physical currency in existence. This fractional reserve principle meant the Bank of England could, in effect, create money from nothing, or more precisely from the government's promise to pay interest. The initial loan of £1.2 million enabled the bank to issue perhaps £3 or £4 million in banknotes, all circulating as currency while generating interest income on the government debt that backed them. The bank's shareholders had discovered perpetual profit. They earned 8% on the government debt. They earned fees on every transaction involving their banknotes. And they wielded enormous political power because the government now depended on them for credit and monetary policy. The relationship was symbiotic but unequal. The government needed the bank to finance wars and operations. The bank needed the government to guarantee its notes and protect its monopoly. But ultimately, the bank had leverage because it controlled the money supply. If it restricted credit, the government faced crisis. If it expanded credit, inflation and financial instability threatened. The bank's private owners, motivated by profit rather than public welfare, would make decisions that served their interests, knowing the government had little choice but to accommodate them. The model spread across Europe within decades. France established the Banque Générale in 1716, later reorganized as the Banque Royale under John Law, a Scottish economist and convicted murderer who fled Britain and reinvented himself in France as a financial genius. Law's system was even more audacious than England's. He didn't just create a bank, he created an entire financial structure linking government debt to colonial ventures in Louisiana through the Mississippi Company, issuing shares and banknotes that were supposedly backed by the vast wealth that would be extracted from French territories in North America. The scheme was brilliant marketing and terrible economics. The wealth didn't exist. The Louisiana territories were largely unexplored wilderness occupied by indigenous peoples who had no interest in French exploitation. But through aggressive promotion and market manipulation, Law drove share prices to absurd levels, creating France's first major stock bubble. When reality inevitably intruded and investors realized that Mississippi wasn't producing the promised riches, panic ensued. The bubble collapsed in 1720, destroying fortunes and faith in paper money. Law fled France, and the Banque Royale's notes became worthless, but the principle had been established. Central banks could create money, finance governments, and enrich insiders right up until the moment confidence broke and the system imploded. The Netherlands had established the Amsterdamse Wisselbank in 1609, earlier than England's bank but with a different purpose. It was primarily a municipal bank designed to standardize currency and facilitate trade in Amsterdam's commercial empire. But it too discovered the profitable business of government lending, holding deposits of precious metals while issuing paper receipts that circulated as money. The pattern was universal. Whether in England, France, Netherlands, or later Sweden, Spain, and Prussia, central banks emerged from the same imperative. Governments needed money to wage wars and pursue imperial ambitions, and private financiers were willing to provide that money in exchange for monopolistic privileges, guaranteed returns, and the right to create currency. The American colonies watched this European model with deep suspicion. The founding generation understood that central banking concentrated power in ways fundamentally incompatible with republican government and individual liberty. Thomas Jefferson wrote extensively about the dangers, arguing that banking institutions were more dangerous to liberty than standing armies. He believed that the power to create money should reside with elected government, accountable to the people, not with private corporations motivated by profit. Alexander Hamilton disagreed, advocating for American adoption of the British model. Hamilton had studied the Bank of England's operations and admired its efficiency and the stability it provided to British public finance. He believed America needed similar institutions to establish credit, facilitate commerce, and compete with European powers. The debate resulted in the first Bank of the United States, chartered in 1791 with a 20-year term. The structure mirrored England's bank closely. It was privately owned, with the federal government holding only 20% of shares, but it had quasi-public functions including holding government deposits, issuing banknotes, and providing credit to the Treasury. The first bank was controversial from inception. Jefferson and his allies opposed it as unconstitutional, a betrayal of revolutionary principles that had fought against consolidated power. Farmers and small merchants distrusted it as an instrument of Eastern financial elites designed to extract wealth from ordinary citizens through debt and interest. When the bank's charter came up for renewal in 1811, Congress narrowly voted against it. The first Bank of the United States died, and for 5 years America operated without a central bank. The War of 1812 proved financially chaotic without a central bank to coordinate government borrowing and currency issuance. State-chartered banks proliferated, each issuing their own notes of varying reliability. The federal government struggled to finance military operations, resorting to bonds sold at significant discounts and currency issued directly by the Treasury. When peace came, the financial disorder convinced even some previous opponents that a central bank might be necessary. The Second Bank of the United States was chartered in 1816, again with a 20-year term, again following the English model of private ownership with public functions. And again, the bank generated fierce opposition, particularly as it exerted power over state banks by demanding they maintain adequate specie reserves to back their notes. When state banks issued excessive currency, the Second Bank would acquire those notes and demand redemption in gold or silver, forcing discipline on institutions that preferred inflationary lending. Andrew Jackson made destruction of the Second Bank his primary political mission. Jackson's opposition was visceral and ideological. He saw the bank as aristocratic privilege incarnate, a monopoly that enriched a wealthy elite while exploiting farmers, workers, and small businessmen through its control of currency and credit. Jackson called the bank a hydra of corruption and used every power of his presidency to kill it. When Congress passed a bill to recharter the bank in 1832, 4 years before its charter would expire, Jackson vetoed it with a message that remains one of the most powerful presidential statements on money and power. He argued that the bank's private shareholders, many of them foreigners, wielded power that no private entity should possess in a republic. He declared that if government was to grant privileges and monopolies, they should benefit the many, not the few. And he committed to preventing the bank's recharter regardless of political cost. Jackson won re-election in 1832 overwhelmingly, interpreting his victory as a mandate to destroy the bank. He ordered withdrawal of federal deposits from the second bank and their redistribution to state-chartered banks called pet banks by his opponents. The bank's president, Nicholas Biddle, fought back by contracting credit, deliberately creating a financial panic to demonstrate the economy's dependence on the bank and force Jackson to relent. Biddle's strategy backfired. The panic hurt the economy but proved to Jackson's supporters that the bank was exactly the threat they'd claimed, a private institution willing to sabotage the nation's economy to preserve its own power. When the bank's charter expired in 1836, it was not renewed. The second bank continued briefly as a state-chartered bank in Pennsylvania before failing entirely in 1841. America would not have another central bank for 77 years. The period between 1836 and 1913 is often portrayed as financial chaos, a time of repeated banking panics, unstable currency, and economic volatility that proved America needed a central bank. And there were indeed panics in 1837, 1857, 1870, 1893, and 1907, each bringing bank failures and economic hardship. But the era also saw unprecedented economic growth, westward expansion, industrialization, and rising living standards. The question of whether a central bank was necessary or whether alternative reforms could have achieved stability without concentrating monetary power remained hotly contested. What ended the debate wasn't economic logic, but political maneuvering following the Panic of 1907. That panic began with failed speculation in copper markets by a group of financiers who'd tried to corner the market and lost spectacularly. Their failure triggered runs on banks they were associated with, and panic spread throughout the financial system. Without a central bank or government resources to provide emergency liquidity, private financier J.P. Morgan organized a bailout, rallying other wealthy bankers to provide loans to failing institutions and prevent total collapse. Morgan's intervention was credited with saving the economy, and he was lionized as a hero. But the crisis also revealed, conveniently for those favoring a central bank, that America's financial system was vulnerable and dependent on the whims of private individuals like Morgan. The solution, banking interests argued, was obvious. Create a central bank that could provide systematic stability rather than depending on individual financiers. But the public and many politicians remained suspicious of concentrated financial power, particularly power residing in New York banking interests who dominated finance since the early Republic. So the campaign for a central bank was conducted through stealth and misdirection, most famously in the secret meeting at Jekyll Island in November 1910. Senator Nelson Aldrich, a Republican from Rhode Island with extensive ties to banking interests and father-in-law to John D. Rockefeller Jr., organized a week-long gathering at the exclusive Jekyll Island Club off the coast of Georgia. Attending were representatives of the nation's most powerful financial institutions, J.P. Morgan & Co., Kuhn, Loeb & Co., National City Bank, and others. They traveled in secret, using only first names, to avoid press attention and public scrutiny. Over the course of a week, this group drafted what would become the blueprint for the Federal Reserve System. The plan they developed was deliberately complex, designed to obscure the reality that they were creating a central bank controlled by private banking interests. Instead of one central institution, there would be regional Federal Reserve banks, giving the appearance of decentralization. Instead of explicit private ownership, member banks would purchase stock in regional Federal Reserve banks, becoming shareholders entitled to dividends. And instead of direct government control, there would be a board of governors appointed by the president, but operating with independence from political interference. The structure created plausible deniability. It wasn't a central bank controlled by Wall Street, proponents could claim. It was a decentralized system with regional banks and government oversight. But the reality, obvious to careful observers then and now, was that the Federal Reserve System concentrated monetary power in ways that exceeded anything Jackson had fought against. And it did so while providing private banks with both ownership stakes and operational control. The Federal Reserve Act passed in December 1913 after aggressive lobbying and political maneuvering. It passed during a late-night session just before Christmas recess, when many congressmen had already left Washington, hardly a sign of transparent democratic deliberation. President Woodrow Wilson signed it immediately, later expressing regret in private correspondence, writing that he had unwittingly ruined his country by enabling the Federal Reserve's creation. Whether Wilson actually wrote those words is disputed, possibly apocryphal, but the sentiment reflected real concern among many Americans that monetary power had been handed to the very banking interests the founding generation had warned against. The Federal Reserve's structure confirmed these fears. Each regional Federal Reserve Bank was owned by member banks who purchased stock and received guaranteed dividends of 6% annually. The Board of Governors in Washington provided nominal oversight, but the New York Federal Reserve Bank, closest to Wall Street and staffed by individuals with deep ties to major financial institutions, dominated policy. When World War I erupted, the Federal Reserve facilitated massive government borrowing to finance American participation, exactly as the Bank of England had done for British wars. The pattern established in 1694 repeated in 1917. Central banks enabled government war spending by creating money and lending it at interest, with the public bearing costs through inflation and taxation while banks collected guaranteed returns. The Federal Reserve's first 2 decades demonstrated its primary function. During World War I, it enabled deficit spending that would have been impossible under a gold standard or without a central bank. During the 1920s, it fueled a credit boom through low interest rates and expansionary policy, inflating asset bubbles in stocks and real estate. When those bubbles burst in 1929, the Fed's response was disastrous, allowing the money supply to contract by 1/3 and standing by while banks failed by the thousands. The Great Depression that followed was substantially caused, or at least severely worsened, by Federal Reserve policy failures. Yet rather than being abolished for incompetence, the Fed emerged from the Depression with expanded powers and responsibilities. The pattern would repeat throughout the 20th century. Crisis, whether caused by the Fed or merely exacerbated by it, became justification for giving the Fed more authority, more tools, and more power over the economy. World War II again demonstrated central banking's primary purpose. The Federal Reserve financed war spending by purchasing government bonds, creating money to do so, and holding interest rates artificially low to reduce government borrowing costs. The result was inflation suppressed during the war through price controls and rationing, but which surged after the war when controls were lifted. The public paid for the war through reduced purchasing power, while banks and bondholders collected interest on the debt created to finance it. The mechanism was elegant and profitable for those who understood how it worked, and nearly invisible to everyone else who just saw prices rising and blamed scarcity or corporate greed rather than monetary policy. The Bretton Woods era from 1944 to 1971 gave the Federal Reserve global power through the dollar's role as international reserve currency. Central banks worldwide held dollars as reserves, and those dollars were liabilities of the Federal Reserve, meaning the Fed could effectively create money that central banks globally would accept as valuable. This dollar hegemony provided enormous advantages to the United States, but also concentrated power in the Fed beyond anything previously imaginable. When Nixon closed the gold window in 1971, the Fed's power increased further. Without even the theoretical constraint of gold convertibility, the Fed could create unlimited money, the only limits being inflation and loss of confidence. The modern Federal Reserve operates with powers that would shock the founding generation. It can create money in unlimited quantities through quantitative easing. It can set interest rates below inflation, effectively taxing savers to subsidize borrowers. It can purchase assets of questionable value to bail out financial institutions. It can extend secret loans to foreign central banks and domestic corporations. And it operates with minimal oversight, refusing to disclose recipients of emergency lending or the collateral accepted. The Fed calls this independence, necessary to insulate monetary policy from political pressure, but independence is just another word for unaccountability. The Fed answers to no one, exercises powers greater than most government agencies, and can make decisions affecting millions of lives without democratic input or oversight. And who benefits from this system? The pattern established in 1694 continues. Commercial banks own shares in Federal Reserve banks and receive guaranteed dividends. Large financial institutions have intimate relationships with Fed officials, often hiring them after their government service and providing them with lucrative positions. The revolving door ensures Fed policy aligns with financial industry interests. When crisis comes, banks receive bailouts, emergency lending, and favorable policy, while ordinary people face unemployment, foreclosure, and austerity. The 2008 financial crisis revealed this dynamic starkly. Wall Street firms received trillions in loans and guarantees, while Main Street faced the worst recession since the Depression. The dark origins of central banking aren't ancient history, they're the blueprint for how the system operates today. Central banks exist primarily to enable government deficit spending and to protect financial institutions from the consequences of their own risk-taking. They concentrate power in unelected technocrats who operate with minimal oversight. They serve the interests of those closest to them, large banks and financial firms, while imposing costs on everyone else through inflation, asset bubbles, and economic instability. And they justify their existence through crisis, using every panic and recession as evidence that they need more power, more tools, more authority, never acknowledging that they often cause the crises they claim to solve. Understanding this history means recognizing that central banks aren't neutral public institutions. They're products of backroom deals between governments and financiers, designed to serve both by enabling spending that would be impossible through taxation alone, and by providing guaranteed profits to private banks. The language has changed. We talk about price stability and full employment rather than war finance and banker profits. But the underlying mechanism remains unchanged. Central banks create money that dilutes everyone else's savings, lend to governments at interest paid by taxpayers, and bail out financial institutions when their bets fail. That's what they were designed to do in 1694, and it's what they still do today, just with more sophisticated justifications and more complex operations that make the wealth transfer harder to see. The next time a central banker tells you they're serving the public interest, remember Jekyll Island. Remember the backroom deal that created the Bank of England. Remember that these institutions were born from war, desperation, and the desire of financiers to profit from government debt. They may claim to work for you, but their origins reveal who they really serve. And those origins have never been overcome, just obscured by complexity, justified by crisis, and protected by the power they've accumulated over 3 centuries of concentrating control over money. If this gave you a new perspective, hit subscribe. History doesn't repeat, but power always protects itself. And the central bank protecting the system right now was designed for exactly that purpose from the very beginning.